Are you looking to master the day trading space as a futures trader? Rest assured, you need to know the details between the markets that we're trading, the watch list that we have to monitor, the specs, the symbols, and all things in between with different specs on the contracts, the leverage, the tick increments. You know it. Lots to learn. We got you covered. Sean Kozak here, tuning in again with NeuroStreet, and for the world's best trading education and strategies, make sure you hit that subscribe button, and don't forget to turn that notification bell on. That way, every time we put out content like this, you can get results. Now, be sure to ask a question, leave a comment, and give us a thumbs up so we know you're engaged in the content. Now, I think it's really important that we talk a little bit about the importance of this video. As a futures trader, it's very different than other markets, and we've said this before in some of the other series, but I want to kind of recircle back to this. First and foremost, there's not thousands of markets in futures. There's only the main markets the pros trade. And there's different months, there's different contract dates, there's different leverage, there's different margin, there's different specs, and we need to make sure you know this moving forward. That's why all of our futures traders in our live classroom are so successful, is because they know their markets and they approach it like a professional. So what I want to do is I want to talk a little bit about the topics today so that you can leave here feeling empowered. First and foremost, future symbols are absolutely critical that you understand, also known as the ticker, but they're very different than, say, stocks or Forex. Then we're going to talk about the month codes and the year codes because futures are contracts and they expire. And we talked about in the other videos how they roll over. You need to know the rollover terms. If you haven't checked that out, make sure you check the videos down below. But we're going to go into more detail on this because what we're going to do is make sure you never get off guard on trading the wrong coded months and the wrong symbols. Then we're going to talk about the master watch list. Now, futures is really powerful because you only really need to be trading specific markets on a regular basis. All the professional day traders really only focus on major, maybe 6 to 8 markets at max, and we're going to teach you how to build that watch list, why we trade those markets, and why you need to be looking at them too. Then we're going to end with contract specs. Every market is different. It's different leverage, different rules, different volatility, different volume, different tick increments. So we want to make sure that you know the things you need to know, and more importantly, the key websites that are going to give you the details that you're always ahead of the game. And we use this stuff every day in our live classroom, so rest assured you're going to be using top-of-the-notch stuff, and we're going to make sure you know this stuff moving forward. Let's jump on the charts. I want to show you this stuff. Don't waste any more time. Keep it super simple so you can leave here with results. All right, traders, we're going to carry this series on into the third Futures Explained series, and we're going to look at watch lists and contract specifications. Now, the purpose of this video is actually, it's quite important. We want to be building a watch list of markets that we're trading, and then we need to understand the differences between each of the different markets because each market it moves in different valuations, and each tick is different in value to each other market. So this is a few things you're going to have to watch and learn here and then implement as you move forward in the markets. So first things first, let's talk about the symbols. So like the stock market, futures are identified by a ticker, right? The main difference is that futures are not just 4 letters like you would see in the stock market. Instead, they actually consist of 1 to 3 letters, and sometimes with numbers, right? And each symbol is unique to the contract. And what's important is that symbols will vary by different exchanges, even if the contract is the same. So some exchanges will call one market the S&P, some markets will, or the ES for the S&P, and then there'll be other exchanges where they'll call it the ES with a number beside it, right? It really just depends on how the exchanges identify each contract. Now, symbols will also vary by platforms despite being the exact same contract. So what's really important is that some of you might be using NinjaTrader, some of you might be using TradeStation, some of you might be using TradingView, maybe you're using other platform, but we're all trading the ES contract, which is the S&P market, right? Or we're all trading the crude oil contract, which is the CL market. But sometimes you will find that the platform or the exchanges will label the ticker slightly differently, which in my experience, I don't understand why they do that. It's just the way the industry is. You know, it would make it much easier, and this is me just giving my own experience and my own 2 cents here as I share this video with you, but it'd be much easier if they just kept it all the same across all platforms and all exchanges, but that's not the case. So let me show you some examples. Unlike stocks, futures expire, right? Monthly or quarterly. So expiration will either be every month or every quarter. And what will end up happening is there'll be an identifier that will basically be what we call a month code, right? And that just kind of tells you the code in which the month is expiring or the year in which the contract is expiring. It'll have a date, right? And when we look at it, to keep it simple, you're going to notice down below that I've given an example of the S&P contract, the S&P 500 futures E-mini contract. So ultimately, the S&P 500 March 2019 contract could be an ESH9 or an ESH19 or an ESH9 with a space between the two or an ES0319. They're all ES. It's just some platforms and some exchanges will label them differently. And since our primary futures platform is NinjaTrader, you're going to often see this as the, oh, that's the wrong color. You'll often see this as the layout, because I know TradeStation is a little different. I know TradingView is a little different. There's other platforms that are a little bit different, but for the most part, the reason I like this one so much is it tells you the month, it tells you the year, right? But the H is the third month, right? 9 could be 2019 or this, right? It could be 319, right? This technically is the exact same if there's a space between the two, right? It's just a way that the platforms identify them, right? So here's an example of a master watch list. Unlike stocks and other markets, futures don't have thousands of futures markets. In fact, that's one of the benefits and simplicities to trading futures, is that there's a basket of preferred markets. That'll be your main watch list. You can choose to add any of the markets that you're interested in trading. However, keep in mind the futures markets is different than stocks. Different markets require different data providers, and that can be quite costly. So this is the main list that you'll normally see us as a school trading. You'll normally see us trading the stock market indexes. Those are the primaries. I don't really encourage new traders trading the DAX. It's a very dangerous market. It's very fast. It's very, very expensive, and it's a European market. The four primaries are the S&P, the NASDAQ, the Russell, and the Dow Jones. That's the S&P Futures 500 contract. That tracks all 500 S&P stocks. The NQ tracks the NASDAQ 100. The Russell tracks the small cap index, and the Dow Jones is the diamonds, right? And then you've got currency futures. So you've got the Aussie dollar, the British pound, the euro dollar, the yen, and the British pound here. Oh, I've got the British pound here. I should have the CAD dollar. That was a mistake. It should say 6C here. So this should say 6C. And that should say the CAD dollar, the Canadian dollar, okay? And the thing here is, when we look at this, the only market that I normally cover in our classroom is the euro dollar, because it's got the most volume for futures. And if you are going to try to trade the currencies, most people are trading spot forex for that, because the volume is there, okay? Now for energy markets and metals, this should say energies and metals. It's crude oil, gold, and natural gas. So the energies and metals markets, you're looking at crude oil, gold, and natural gas. Normally, it's just going to be crude oil and gold. Natural gas is what we call the widowmaker. It's very explosive and quite dangerous, and can be very extreme if you're not a good trader. So like the natural gas market or the DAX, these are very high-risk markets. These can be also high-risk, but these are the primaries. And if you are trading the debt markets, like the bond markets, this tracks the 10 and the 30-year notes. I personally don't normally cover them in the classrooms. Our instructors don't normally cover them because they move very slow. But if you take a look, this is an old watch list. Maybe last year, I think we took that picture. And you'll notice that the dates, you see all these, they all have a date, right? Like the Dow Jones 1218, that's December 2018 contract, right? You can see this was all taken on the 2018 year. And so if we had a market watch list that was current, okay, a market watch list that is current, you'll see all current. So let's go in and load one of those on our platforms, and I'll show you an example. So we'll just pull up a watch list here. So this is a great example. I have a main watch list that I normally have, and this is just the scanner, but when you load our workspaces, you're going to see that this is a a market analyzer, you'll see I've got the stock indices up here. I've got the S&P 1220 contract, the YM 1220, the NASDAQ 1220, and the Russell 1220. This is ultimately just the current month, right? I'm trading. We're in November right now at this time of filming the video. This is actually November 11th, Remembrance Day up here in Canada. And you'll notice I have the micros here. These are actually just smaller versions of the full index contracts. So the MES is the S&P, but the micro, it's a much smaller contract for traders that have less money trading a little bit smaller accounts. And so ultimately we have a video on the micros. We'll talk about that in a little bit. The energy, you'll see I've got crude oil, then I've got metals, gold, and then I've got the euro dollar. I could add a whole bunch of other markets down here, but it's not going to be the primaries that you'll be looking at when you build your watch list. So you always want to make sure you have a watch list built of your main markets so that you're always in tune with the markets that you're trading. So let's kind of shift gears now and talk about why it's really important to understand your markets. Every futures contract varies because it's an independent market. Just like if you're looking at, say, Google stock, it could be trading at $400 where Visa's trading at $100, right? Like they're different companies, so they're priced differently. So futures contracts are the same. They're technically different assets, contracts tracking different underlying assets, so their valuations are going to be different, which means every time the market goes up or down an increment, in futures we call them ticks, in stocks we call them cents or pennies, and in Forex we call them pips. So in futures it's actually called ticks. So every time the market goes up one or down one, we say it went up one tick, or it went down 3 ticks, or 2 ticks, or 10 ticks. And then after it reaches a certain amount of ticks, it would become a point. So I'll give you an example. Crude oil, okay, crude oil moves in 0.01 tick increments. And there's 10 ticks per point. So, and then there's, because it's valued in dollar increments. So, you could go, it could be valued at $67.05. And if we went to $67.35, okay, that means that this market dropped, 30 ticks, right? Or excuse me, this market went up 25 ticks. So you'll say if this market lifted, this should have been 66. But what I'm trying to get at here is that whenever we move up or down these increments, it's going in tick valuations. We're going to take a look at some charts here, show you some examples, but I'll read this example here. The minimum tick is the minimum movement that is captured by an instrument, right? If the tick is 0.01, this means the minimum price movement will be recorded as 0.01. An example here for crude, I'll use this example. The future contract for oil, it's trading at 67.01. If the minimum change in the price that will be recorded from 67.01 to 67.02, or from 67.01 to 67, this is the definition of a minimum tick of one variable. So, the main thing here is that every time it moves a tick, it's worth something because futures contracts are leveraged, right? Where a stock is not. A stock is a penny. It's 1 cent valuation, 1 cent share, 1 penny. For ticks, it's not the case because futures contracts are leveraged assets. So every time you have a different market, these markets have different valuations. So we're going to take a look at some tables here, and we're going to show you what that means. When we look at a tick value, this means how much each tick movement is worth. So for example, if we're talking about futures contracts for oil, the definition of an oil contract size is 1,000 barrels. Thus, the tick is 0.01. The tick value is equal to the contract size multiplied by the minimum tick. In our oil contract example, 0.01 times 1,000 equals $10. In summary, every time a market upticks or downticks, 1 tick up or 1 tick down, if it went from 67.01 to 67.02, if you were trading one contract, that would be $10 movement. It moved up 1 tick, per contract, that's $10, which is, it's very, very, very leveraged. These markets are very leveraged, which means you don't need a lot of movement to make a lot of money in futures, depending on the position sizing that you're using. So let's kind of give you some examples, because oil is a very basic example, because it's easy to understand oil. We're going to show you some charts, and ultimately, but the other markets have different valuations. So I'll explain why this is important, okay? It will help you understand your risk tolerance, because some markets are designed for smaller risk amounts, meaning there's markets like the NASDAQ or the Dow Jones, they have smaller movements. They move, like their tick valuation is less. Now, some markets are a little bit more expensive, like crude oil and the S&P contracts. Now, you can actually access some of our manual files. We have some downloads in the members area that will break this down. But I'm a firm believer of just going to the websites and just taking a look. There's a good example of barchart.com, barchart.com/futures/contract specifications/currencies. But I'm going to show you an example what this is. This is a picture of that website, and we're going to talk about it, because we're actually going to go to this website and explain it. Or I'll go onto the charts and show you. Let's take a look at the S&P contract, okay? This market moves in 0.25 increments. So it'll go up 0.50, and then 0.75, and then it'll be 1.0, and then 1.25. So it moves up in 0.25 increments, and every time it moves up one tick or down one tick, it's $12.50 per contract. And that means that every time it moves 4 ticks, it's considered 1 point, because the point value is $12.50 times 4 before it becomes one whole decimal. And that's, let's take a look at, say, the NASDAQ. Same thing with the NASDAQ. The NASDAQ does the exact same thing. The only difference is the NASDAQ's not worth $12.50. It's worth $5. So every time the NASDAQ moves up 0.25, it's actually almost 2 times less the risk. It's just the NASDAQ's a little bit more volatile. So other markets like the Dow Jones, the YM, it doesn't move in 0.25 increments. It literally just moves 1 point at a time. So it moves up 1, 2, 3, 4, and every time it does that, it's $5. So this is something that's very important to understand, that every market's different. And so what we're going to do here is we're going to open up some charts, and I'm going to show you some examples. Another thing we can do as well is we can go to that website. I'm going to pull that browser up, and we'll take a look at that as well. So this is the website. This is one website. There's many websites that you could literally just Google contract specifications for futures. The reason I like this one is because it has tabs at the top, and so it's a free website, barchart.com. Currencies, energies, financials. Like if I wanted to look at crude oil, natural gas, right? And the big thing here is just understanding that, and that's the main thing here is understanding that every market's different. If I want to go to the indices, you see the S&P here. Right, the S&P is different than, say, the NASDAQ or the Dow Jones. If I want to go to currencies, the euro dollar, there's the Canadian dollar, there's the Japanese yen, there's the euro dollar and stuff like that. And so the big thing here is just knowing that every market's a bit different. So let's kind of go in, and I'll just kind of explain how to read this. Let's say I want to go to crude oil here for a second. Let's go to crude oil, go to energy markets. Okay, so if you see here, crude oil is crude oil has the CL market, and it's telling us that it's moving in 1 cent increments, which is 1 tick. And every time it moves a tick, it's worth $10. And every time it moves 100 ticks, it's 1 point. 1 point is worth $1,000. So let's kind of go and show you some examples. I'll grab crude oil here for a second, and I'm just going to link these for a second. Orange to orange so we can see this. Let's just click on crude oil. There it is. So I'll give you an example here that, if you look at the side of this chart, you're going to see that it moves up in increments of 44, 45, 46, 47, 48, 49, 50, right? So, you know, if we go down to 44, 40, like this is 10 ticks, okay? 10 ticks. For whatever, how many contracts you're trading, if you're trading one contract, that would equal $100 because every time it moves up one tick, it's 10 bucks. So if I literally move from here to here, depending on how many contracts I'm trading, will be based off how many ticks it moved, value based on 10 bucks per tick. If I move up, if I went from 40 to 50 with 10 contracts, that would be worth $1,000. It's not a lot of movement. The market's a 5-minute chart. That's not a lot of movement. And this is the risk with futures, is that you're leveraged very highly, which means you need to be very specific with the market. Okay. So the other thing too is, let's take a look at a different market. Let's take a look at, say, gold. Gold is the same. Gold is worth 10 bucks a tick, but it moves up in 10-cent increments as well. You'll see that it moves up, you know, 9 to 0 to 1, 2, 3. So if I moved from this 62 valuation, if oil is trading at 11.62 and I move to 11.63, that's 10 cents. Technically, that's 10 ticks. And basically, that would be $1,000 per contract. Or excuse me, that would be $100 per contract, $1,000 per 10 contracts. If I'm going up, say, on the S&P, the S&P is slightly different. The S&P moves up in 0.25 increments. So if I'm looking here, you can see right here, if I went from 35.60 to 35.61, that's 1, 2, 3, 4 ticks. That's $50 per contract. That's a lot of potential movement. Okay, that's a lot of potential movement per profit of movement, meaning you don't have to move very much to make a lot of money in futures, but you still need to be right about what you're doing. And so this is where I just think it's super important that if you're going to trade any of these assets, that you understand your risk tolerance, know the difference between ticks and points, know that every market's slightly different. If you ever need to learn those markets, you can literally just go to, say, barcharts.com, go under futures, under the tab here, right? And then just go to contract specifications. So you can just click on futures. You can go here, contract specs. It's very simple. And then you've got all these tabs up here. Now, there's a lot of websites that allow you to do that, but I think this is a great one to get started. Okay. So it's very important that you learn the valuations, very critical to risk management. If you need any assistance, or if you ever have questions on this, or if something didn't make any sense to you, you know, this is a primer video. You're going to learn a lot of this as you're trading in a simulated account. Rest assured, it's always best to trade in a simulated account first, because that way you'll see the movements, you'll see the market move up and down, you'll see the valuation per contract, and you'll be able to gain an understanding of your comfort level as well as your risk tolerance as the market's moving. All right. And like I said in all the other videos, if you ever need us, or if you ever just need to get on a computer or do a screen share, if you have any questions, let us know. Be more than happy to help you. Take care, traders, and we'll see you in the next video. Welcome back, traders. Hope you enjoyed the content in this video. Definitely stuff you want to make sure you know moving forward. Now, we've also put out a ton of other videos in the series, so down below this, you're going to see a bunch of links. Be sure to check them out so that you can stay in the know moving forward with the future series. Now, make sure you hit that subscribe button. It's going to help our channel grow. More importantly, that notification bell needs to be turned on so that you're always in the know with our content. Be sure to share this video with your friends, because they're definitely going to learn something valuable too. Also, at the end, make sure you ask a question, leave a comment. We can get social with you and help you get the results you're looking for. Take care, traders. We'll see you in the next video.